Good morning, and thank you very much. Good morning, Chairman Farrell. Good morning, Chairwoman Young, senators and assembly members. I'd like to highlight in my testimony today two particular tax-related proposals in the executive budget, and then turn to a third tax policy concern that I believe has been overlooked in the executive budget that deserves your attention. The first area is small business tax cuts, which has been alluded to here today. As you know, the budget calls for a further reduction in state taxes on owners and shareholders of farms and small businesses, including limited partnerships. Given the income eligibility limits for this tax cut, what you're talking about really is the smallest end of the small business scale. Now, $298 million may sound like a lot of money, but when you whack it into a million pieces, you end up with an exceedingly modest tax cut, first of all. Second of all, the issue of the minimum wage has been raised here today, and generally in news reporting on this issue, there's been some link made in some minds between this proposal and the minimum wage increase, the proposal to raise the minimum wage to $15 an hour. I think it's important to point out that the proposed tax cut wouldn't even begin to offset a fraction of the cost most small businesses would incur as a result of the minimum wage increase. The added expense of a $15 minimum wage, in fact, will easily exceed the entire state tax liability of a typical small firm employing workers making between $9 and $15 an hour. It will be many times, and you could easily conceive of situations in which in fact, this tax cut, the cost of the minimum wage would be hundreds of times the value of this tax cut. So my point is that whatever other merits this tax cut has, or doesn't have, it should never be discussed or considered in the same context as a minimum wage increase. There's no conceivable tax cut that can even begin to make up for the economic or business impact of a minimum wage increase. Second issue I'd like to talk about is the throughway toll credit, the so-called tax cut in the governor's proposal, which would devote $340 million over 3 years to reimburse motorists for half their throughway tolls. This proposal is objectionable on several grounds. To begin with, if the toll credit is a solution, what exactly is the problem? After all, tolls on the New York State Thruway are not out of line with tolls on other state interstate toll systems. In fact, they're lower than some neighboring toll systems. At the same time, the Thruway has continuing significant capital needs that go well beyond the cost of replacing the Tappan Zee Bridge, which, I would point out, previously generated tolls that help subsidize the entire system. And oh, by the way, if you do the quick arithmetic, which drivers on the Thruway system will most rapidly and readily collect tax credits from this proposal? It would probably be people who, in the space of less than a month, rack up tolls crossing the Tappan Zee Bridge, not people in upstate New York. Not that there is any regional preference that should be shown to this. The most objectionable aspect of this proposal is that it represents a completely inappropriate use of a highly unusual one-shot infusion of revenues. At a time when capital resources are scarce and infrastructure needs are great, you're being asked to basically squander $340 million. This proposal does not deserve support in any corner of New York State. It's an indefensible gimmick, a bad idea, a flat-out waste of money that could be better spent on actual capital purposes, and if we had more time, I'd try to share with you what I really think of it. Last but not least, the unfinished business category, which is very important. 2 years ago, at Governor Cuomo's initiative, you took the very, very important step of raising New York State's tax exclusion, the taxable threshold for estates, from $1 million to match the level of the federal estate tax, which is currently about $5.5 million and rises with inflation. While we'll remain one of very few states that impose any estate tax, the reform was a huge step forward, and it really takes the cloud of a death tax away from hundreds of thousands of families, small businesses, and farms around the state. Unfortunately, the legislation also preserved outdated aspects of the old estate tax law, including a steep tax cliff just above the level of the exclusion. The result, as has been estimated, is you actually have people who would hit a confiscatory 164% marginal tax rate. Consider this situation. A family farmer surviving children could find an extra combine in the barn after dad dies and find themselves taxed at the same level as a Rockefeller heir. This is a mistake. You can fix this, and you really ought to. This is not consistent with the goals you or the governor had when you did that tax cut. So you should revise that in the next budget, I would suggest. In conclusion, the biggest loose ends of all in the tax code continue to surround and ensnarl the personal income tax. The major elements of the tax brackets at just about every level and the temporary indexing provision are, as I indicated, totally temporary. They expire again at the end of 2017. Our high top income tax rate, which for 2009 has been among the highest imposed in any major industrial state, is an economic negative because it creates a disincentive to work, save, and invest here. Now, you can see the revenue that comes in from this. What you don't see is the revenue you lose now in the future and in the future by discouraging wealth creation and investment in New York. Economic considerations aside, fiscal stability is another substantial reason to begin to phase out the so-called millionaire tax. About 43% of personal income tax receipts now come from the top 1% of filers, people whose incomes begin just below $1 million. That means that 27 cents out of every dollar the state collects from all tax sources will be generated by fewer than 100,000 taxable households. Now, since the recession, the comment was made that we have tackled the tax burden. I would point out that since the recession, New York has not reduced state taxes. Repeat, not. In fact, you've increased the overall state tax burden since the recession. Instead of reducing taxes, you have raised and redistributed the tax burden. The so-called millionaire tax, which didn't exist before the recession, will raise nearly $4 billion this year. About 3/4 of that amount has been or is in the process of being redirected for purposes described as tax cuts, some of them temporary. This is the answer to Assemblyman Farrell's question, where is the money coming from? That's where it's coming from. There are clear risks associated with depending so heavily on such a small number of taxpayers. It means when the high-income taxpayers have a bad year, the entire state suffers inordinate stress. It's happened before, and it could happen again. It could happen again very soon. Let me point out that the budget projects a 5.3% increase in the capital gains income of New York residents. That income, it largely flows through high-income households where it's taxed at the top rate. That projection of a 5.3% increase in capital gains income assumes the Standard & Poor's 500 will grow at a modest, relatively low 2.2% level this year. Well, given what's been going on in the market, that would require the market to S&P to rebound in the next 11 months by 6%. Wait a minute, check that. Based on this morning's ticker, by 7.5% over the next 11 months. That could happen. Then again, maybe it won't. In the fourth quarter of 2015, the Labor Department's index of coincident indicators declined for 2 months in a row for the first time since the recession. The subsequent statistical reset may eliminate that. That happened last year, too. However, I'd also point out that the New York Federal Reserve's index of coincident indicators, which is calculated on a different basis, has New York State's economic indicators decreasing at an annual rate in December, which is also the first time since the recession if it holds up after rechecking. These are caution flags. So in conclusion, I would suggest tax policy, in concert with all spending and regulatory policy, needs to reflect economic reality even as it seeks to improve the economic outlook. We need to carefully rebalance the redistribution of New York's tax burden with the twin goals of making the state more competitive and protecting against economic shocks, which are inevitable sooner or later. With that, I'll conclude my testimony and thank you very much for your forbearance.
Thank you.
Thank you.
Mr. Oakes?
Yes, thank you, E.J. A couple things. Actually, just read in my notes while we were sitting here today that there is a proposal by some of my colleagues in the majority on the Assembly side coming out today that would raise tax rates on some of those higher earners and put us in a position of being further more dependent as we go forward. The impact of that, I mean, in your mind, you raised a caution flag on that of saying we are more dependent today than we've ever been. Doing something like that would make us even further dependent. Additional comments, related to that.
The easiest way to describe that is, I think, it's as if you have a group of people who say, we want to rise higher and get a better view. And they climb higher and higher, higher up a tree, and they are now, you want to climb further and further and further out on a slender limb. That's what that represents, the proposal as I understand it. It's also interesting to me that I've been here long enough that 29 years ago, a brand new Assembly Speaker opened his tenure by proposing a sweeping tax reform that featured a flat tax at a rate of 6.5%. How times change. I think the arguments for that plan actually were and remain stronger than the arguments for the plan I heard described yesterday. So, I mean, that issue could be talked about all day long, but I think that is highly problematic. That the phenomenon I talked about at the end of my testimony would be even more pronounced if that policy was enacted.
Do we have any sense on when we did, or when the legislature and the governor put forth the increase before, and we increased on the upper levels? Do we have any numbers that you're aware of whether we have today more people in that bracket, fewer people?
Oh, we have more people in that bracket.
Okay.
That tax was imposed at a very low point when it came to the incomes of high-income households, particularly because of capital gains losses, because there'd been a 20 to 30% drop in stock values. So you had a lot of people who fell below that level. As stock prices recovered, and as, frankly, federal policy and the Fed's policies followed a path that was actually meant to drive more profits to New York's financial sector, in effect, that sector recovered, the city recovered, and those incomes recovered. And that is why the taxes from that segment of the population have grown back, not as high as they were without the tax cut as a share of all income before the recession, by the way, but certainly a full recovery if you include the tax increase.
My other question relates to, you talked some about the minimum wage and its possible impact as well on certain businesses, especially businesses that may pay low wage, and a lot of small ones that are fledgling or trying, that's what the market may allow them to bear. And we know there's going to be impacts in all different sectors, but we've seen some numbers. This is more of a question, I don't know if you have research on or not. We've seen different numbers thrown around that say, if we go to this, we'll lose so many jobs.
Right.
Do we have a sense by sector numbers of jobs? In other words, I mean, I'm most concerned, I think there are some adjustments that are going to take place, obviously, in the nonprofit sector and in public schools and others. You know, will people hire fewer? Will people, will we tax greater in those? The ones I'm most concerned about, very honestly, are those that are making a product or growing a product, having to sell it competitively against other states or internationally where the prices of labor may be significantly different, and their competitiveness. So I'm wondering if those sectors we are anticipating higher numbers.
The short answer to your question is no on a systematic basis, but here's what your common sense can tell you. Here's an example that I've used. Across upstate New York, the regions of upstate New York, there are roughly 12,000 people in the occupation described as childcare worker. The median wage for people in childcare work, in the occupation childcare worker throughout upstate New York, the median in all regions is from the low nines to less than $10 an hour, or was as of 2014. The median, that means half of childcare workers make less than that. Childcare work, of course, is regulated by the state. These are workers in regulated childcare establishments. There is and can be no staffing change in a childcare setting, so that won't happen. What will happen is that in an industry that has a median wage just over $9 an hour, a forced rise of the minimum wage to $15 will result in almost dollar for dollar increase in costs. And those costs will be borne from everybody from working class, lower income working class people, many of whom have their child care subsidized by the state, up to middle class people who struggle to pay their child care bills. That is one of those industries where it's dollar for dollar. I've been involved in discussions with industries. There is a small job shop manufacturing, a small but still thriving job shop manufacturing sector through much of upstate New York still, less so in downstate, of people who make all sorts of different things, apparel, grommets, you name, pieces of computer equipment, things you don't think of. They make a piece of it, and they do it in relatively small quantities, and so it's labor intensive. They tend to pay, they don't pay minimum wage, but they tend to pay $11 or $12 an hour, especially starting. Those people will tell you, and I'll get you their names, they compete with companies across the country to supply. It's not still 100% Chinese suppliers. They supply, the Defense Department, they supply other larger producers of products. They will not be able to compete with they have competitors in other states who will be able to beat them more easily on price because of this. So that's another issue. One last thing, there's trade-offs in taxes, and one was raised earlier. When you come to raising the minimum wage, for instance, fewer people are eligible for a tax refund through the Earned Income Credit. On the other hand, wages are a deductible business expense. I would ask you to ponder what happens to tax receipts when you add $20 billion in deductible business expenses. The business is still paying the wage and having to deal with that issue and it has an impact on employment. If you want to think about trade-offs in tax revenues, there are trade-offs, on the plus as well as in the negative as well as the plus side, unintended consequences of all sorts. So that's just the beginning of it. I could get you some names of some of these people who've talked about this.
Thank you very much.
Thank you. Senator?
Thank you. I guess I'd like to start with a question. And first of all, President McMahon, always appreciate your testimony very much. And just want to say that I'm glad to see that you're finally coming out of your shell. I've always known you to be quiet, reserved, and shy. And you're starting to loosen up, so that's great. So thank you for that.
With coaching, it's getting better.
With coaching, very good. This is a serious question, however, and as you know, GE recently chose Boston, Massachusetts over New York State or Connecticut as the site for its new corporate headquarters. So given our recent efforts to cut corporate taxes in New York, can we draw any lessons for tax policy and business climate from the GE move?
Well, I would say, first of all, it's important to acknowledge up front that taxes alone are never the sole, or even operating costs are never the sole consideration when a major corporation moves. Anybody will tell you that, the corporations themselves will tell you that. It's certainly an important factor. I would point out the Tax Foundation did a really thorough, very interesting study, not their usual index. There's another study they did called Location Matters that rated states as, in terms of how preferable they were from a tax and regulatory perspective for different types of businesses, including new startups, capital-intensive manufacturers, and among others, mature corporate headquarters. New York, the last time they did that study for mature corporate headquarters, ranked 49th. Massachusetts ranked 31st. Now, that was a couple of years ago, right before you enacted the corporate rate cut you enacted a few years ago. So that obviously probably would improve our ranking on that scale. But I would point out our corporate tax was never as out of line, especially when you built in the other credits and factors of our corporate tax, as our income tax now is. And so I would point out that Massachusetts has a flat rate income tax that tops out at 5.1%. We have an income tax that in its permanent form is 6.9 and tops out at 8.8. For the 800 people who will be working in the GE headquarters in Massachusetts, it's clearly not the factor, but it's certainly not a factor to completely ignore either. The overriding issue with the income tax is that most of those people, certainly from the mid-management levels up, will save thousands, in many cases, tens of thousands of dollars in taxes from being in Massachusetts rather than in New York. Collectively, it could reach $1 million or more, millions for the people working in that headquarters. That's not an insignificant factor. Massachusetts has much lower property taxes, as we know. That's largely a factor of having 35 years of Prop 2.5, which is why Prop 2.5 was the governor's model for his tax cap in a general way. That is another important factor. I think that the problem is that in the last few years, all of the things you've been doing about property taxes have been to basically throw targeted breaks at homeowners. That doesn't reduce the overall tax burden for businesses. There was also a targeted break for
With the property
manufacturers.
tax cap, however,
But
that's helped.
Massachusetts has not done things like that. They basically did things that resulted in a lower overall tax burden. So the property tax burden in Boston is significantly lower, not just in New York City, but Albany. So those are some of the tax factors that I think came into play. And I think that if you want to draw any tax lesson from it, one tax lesson would be don't completely ignore the impact of the personal income tax, which surely was one of many factors that they thought about, because the thing Connecticut has been doing relentlessly and repeatedly over the past decade has been increasing its income tax. It had no income tax when GE went there 40 years ago. It started to have an income tax 25 years ago, and it has raised it repeatedly in recent years. And I would suggest to you that that was one of the factors that drove them out of Connecticut.
Thank you for that answer.
Senators? No, I'm sorry.
No? Hi, nice to see you, EJ. So, when the tax commissioner was here earlier, I'm not sure whether you were in the audience yet, I was asking him about any review his department was doing on the governor's tax reform commission proposals, I guess from December 2013 now. And in there, they're recommending exploring changing or even doing away with our business tax credit system, and suggest that that could instead be turned into dramatic across-the-board lowering of business taxes. You've already testified today why you think the governor's small business tax proposal in this budget isn't going to address the real problems. What's your opinion about doing away with the business tax credits and lowering our across-the-board tax rate?
I strongly agree with what I take to be the premise of your question, which I think refers to the Solomon Commission, because you remember the governor had two commissions.
Correct, that is the report I'm referencing.
I think that was an excellent report, and I think it's also, it had an excellent appendix, which was less well-known, but may perhaps even more valuable. The general thrust of most of the recommendations in that report, I think, were very much in the right direction and deserve to be considered. And if the tax department will not consider them, because after all, the tax department works for the governor, perhaps you should consider them. There's a lot of good ideas in there about cleaning up the growth of the underbrush in the tax code that make it inefficient and inequitable. And I agree with the thrust of many of those recommendations.
And do you agree that the money we could glean from doing away with, I think this report talks about $2 billion in business tax credits, if applied to a lowering of the small business needs in the state, could make a dramatic impact on their competitiveness?
Yes, in general, if you cleared away a lot of the exceptions and exclusions from the business tax, and which also apply to the personal income tax, many of them, you could go closer to the goal, which is a widely advocated goal among academics and tax policy of all stripes, of striving to have a broader tax base with lower rates, that's less distortive economically, and it's a better policy. So yes, I think that that's a good direction going.
Thank you. Then you also referenced that the property tax cap, even though you were talking about agreeing with some of the goals of it, has had a negative impact disproportionately on homeowners. I think you just said that.
No, I said that what you've been doing as a group, as a legislature, has been to direct more targeted tax benefits in the name of offsetting property tax burdens only for homeowners.
Oh, excuse me. So I was asking the tax commissioner about reevaluating the way we do assessments, and the fact that we have 1,000 different property tax assessment units in this state. Do you think that would help us address the inequities and some of the strange outcomes we're seeing from our current property tax policies?
Yes, in a word. I think that I agreed with the premise of that question also. I think the tax administration system is a bigger and bigger mess the closer you get to basically the middle of Manhattan geographically. Westchester is really bad and a hodgepodge, an indefensible patchwork system. Nassau is horrific in its own way. sharing the basic structure of New York City, which those of you from New York City know is really, really bad. And of course, the political concern, which I don't have to worry about, but what you do, is that whenever you seek to go into and modernize and streamline a tax administration system and make it more fair, there are losers as well as winners. The losers take notice sooner and scream louder. But there's a huge, huge problem with the administration of property taxes, downstate in particular. Statewide, I would suggest to you offhand that for a fraction of what you're spending on targeted tax breaks for homeowners, just what you did last year, the state could take the lead in modernizing property tax assessments and creating an information technology and training system to create a system where you'd have county-level tax administration. And again, speaking of Massachusetts, Massachusetts has county-level tax assessment updated every 3 years, which would be a revolutionary improvement for the suburbs of New York. Again, the city, as you know, we could be here all day talking about the really weird unintended outcomes and inequities of that system, which requires its own reform.
I think the Assembly actually had a almost all-day hearing on the city property
did.
tax
So
system
I heard.
recently. So I wasn't going to try to use my few minutes to go into that, but I did raise the question earlier with the tax commissioner, because I do think there is so much we can do at the state level, and I didn't really get, to be honest, the answer I was hoping to hear, so I was hoping I might hear it from you. So
Well, I agree, and
appreciate that.
I'm assuming in his defense, again, that's a policy
Right.
perspective that has to begin higher up, but I also agree with the premise of that question.
Thank you very much.
Well,
Thank you. One question. Sal Weprin, flat tax, 29 years ago?
no, Mel Miller.
Oh, Mel Miller, he was before that, 29.
It was when he took, that was his
Yeah, he
initiative, you
took
may
from
recall
Fink,
it, when
yeah.
he replaced Saul.
Okay.
Denny, just
Or not
Yes.
Saul, when he was, before Saul, sorry, yes.
a very quick question. Have you done an analysis on the New York City taxing situation and come up with a plan? You
No, I
could
think
share?
that there have been excellent, between the IBO and the Citizens Budget Commission and a conference they held on the subject a couple of years ago, I think the path to what really would be the best reform is clear. I just think what's lacking is the will to get there.
Thank you very much.
Thank you.
Thank you.